So, welcome everybody. I'm Amit Chandan. And if you're a working professional or someone looking to build a better financial future for yourself, this session is for you. We're going to walk through Trump's latest announcements on tariffs and what they mean to long term investors. Today, my hope is that you're going to walk away with an understanding of how to observe volatility without overreacting and how to connect real world headlines to investing fundamentals. So, with that said, let's get started. But for those of you who are not part of our Telegram community, I've been seeing and sending daily messages and also seeing excellent questions being answered and how the community itself turns around and answers those questions. So if you're not part of this community, do join our free Telegram channel. I'm going to post a link to it in the recorded session in the video. So yesterday, Trump introduced brand new tariffs, and that included a 10% tariff on nearly everything that is imported to US, plus higher rates on specific goods like steel and automobiles. And countries like China and India are facing even higher tariffs. Overall, tariffs that President Trump has announced yesterday were higher than what the markets were expecting. This is why the market started to overreact negatively. And the markets are rattled. And ultimately, what happens is these tariffs end up having a ripple effect through the supply chains, and that can impact consumer prices and businesses. But before I dive deeper into the impacts, let's step back and look at the raw numbers. So this table comes from US Census Bureau, and I have overlaid some of my numbers to analyze what it's saying. The US has massive trade relations with every country, but in most cases, the US imports more than what it exports. So what you notice here is these are the list of top countries that we have. So top countries are here, and how much they export, how much they import, and total trade, and what is the percentage of total trade in US from each of these countries. And by the way, the numbers that I received, these are as of 2022. This was what was available in the US Census Board's website. But the real numbers are going to be very similar, right? Like as of now. So these countries post the following tariffs on US goods. And these are tariffs before this announcement that came out from President Trump. So while China was posing 67% tariff, US was only charging them 3%. In case of Japan, that was charging 46%, US was only charging them 1.9%. Germany, 39%, and US was charging them 2.7%. And the list goes on and on. Vietnam was charging them 90%, whereas US was only charging them 5.1%. So is that fair? Right? So if you look at these tariffs, most of these countries are charging a lot of tariff to US products that are going into their country. And in my opinion, this is not fair. The US's response was actually overdue. So this brings us to the real question of what is the real thing that Trump is trying to do here? What's his goal? It's obviously not about just collecting money, right? Because what are tariffs? Tariffs is essentially that when a product comes into the country, the government charges some kind of a tax. But what happens with that tax is it increases the value of that price or the cost of that price to the consumers. And ultimately, who ends up paying? It's the consumers. So previously, as you noticed, that the tariffs that US was charging was very low. The advantage of that in the past was that the US said, okay, we don't want our consumers to be impacted. But President Trump is saying, well, wait, this is not fair. How come you guys are charging so much and you're not paying that much for all the goods that you send to us? So he wants a fair deal. And why does he want the fair deal? I think he ultimately wants economic and geopolitical leverage. He's saying that if you want access to US consumers, you've got to open up your markets to US products too. And in the meanwhile, by making foreign goods a bit more expensive, he's giving American manufacturers a better shot, right? And a better shot at what? He's basically giving them a better shot at having their products become more attractive to US buyers. Now, that doesn't mean that there won't be short-term pain for US consumers. These kinds of shifts often create pressures, pricing volatility, and uncertainty in the markets. But in the long run, or the long game here, is about rebalancing trade relationships and boosting domestic resilience. So there's another thought in this that if products are being made cheaper elsewhere, shouldn't US just keep letting those countries continue to make those products. But I don't think it's about US saying that, we don't want you to manufacture the products. US is just saying that if you want to carry on manufacturing the products, that's fine. Just make sure that you also allow our products to equally go there. So for example, like he often gives example of India, where it says that, oh, India charges X amount of duty on Harley Davidsons. So India is, what is India going to do? India is going to say, okay, well, maybe we'll reduce the duty, carry on sending your Harley Davidsons. Now it's a different story whether that US product, for example, Harley Davidson, will have that much attraction in the foreign country. We just don't know that. But I don't think that's really the game. The game really is providing an equal and fair access. Now, as I look at these numbers a little more carefully, here's what US has done. So US is saying, yes, you charge us 67% tariff while we were only charging you 3, for instance, in the case of China. US is saying that we're going to raise your tariff from 3% all the way to 34%. So he's come up with some math of his own, which basically says what is a trade deficit? Not necessarily how much your tariff you're charging, but what is a trade deficit? Based on that, he's figuring out that what is the tariff that we should be charging you. Ultimately, if you look at approximate figures for most of these countries other than those in the European Union, you'll notice that it's almost half of it. So he's saying that if you charge us 67%, we'll charge you 34%. If you charge us 50%, for example, in case of South Korea, he says we're going to increase it to 25%. Now, another opportunity here is that if these countries don't play ball, he may say, all right, well, I'm going to keep increasing your tariff, right? But how many of these countries are going to play ball? We already know that Japan has essentially or conceptually said that, yeah, we're willing to negotiate. South Korea has said we're willing to negotiate. United Kingdom, yes. India, yes. So these countries are saying we'll negotiate with you. So they'll come up with some better, open up their economies for reduced tariffs. So basically, so that United States products become more attractive to those countries. And when that happens, look at what happens to the financials of those companies. So if those products start becoming cheaper in these foreign countries, then the sales of the US products increases. And when the sale increases, that increases the company's cash flow, revenue, profitability, et cetera, right? So that's all great for the US companies. And then that ultimately increases the stock price. So that's where he says short term, there's going to be a bit of a trouble, but in the long run, it should make sense. And that's what Trump believes. I also think that's how it's going to be. But ultimately, I believe that these are more negotiation tactics because he's trying to get that leverage. So going back, I already mentioned that Japan, South Korea, India, United Kingdom, these countries are all saying we'll play ball. Other countries are also going to come in, but there are some countries that are going to say, no, we're going to have some strong retaliatory tariffs on you. So which are some of these countries? Well, China being one of the ones that's saying that we're going to have retaliation. And because China equates to 13.2% as of 2022 of how much imports the US has, there is a bit of a clout. But Chinese economy is also heavily dependent on exports. So some point in time, they'll probably have to come to some kind of terms, right? There's also an electric vehicle, BYD. They're trying to sell to US and US is trying to sell more Teslas, right? So it's that leverage that's working out between China and what US is trying to get over that. France is also a country I think that's going to say that, we're going to impose some tariffs on you. So we're going to have to wait and see how market ultimately ends up absorbing this information. We don't have all that at this time because, these tariffs are that hot and that new. They just came out like, obviously yesterday at 4:00, these were announced. Now, between Canada and Mexico, here's something very interesting. The US was imposing 3.4% tax on average on Canada. And now that obviously the US has said that we're going to increase it to 25%. And Canada also said that, okay, we're going to increase it to 25% as well. But what's interesting to note is most of the products that are sold or that are transferred in Canada and US, they are compliant to what's called USMCA. So United States, Mexico, Canada agreement. What this basically says is a whole lot of products go between countries that don't have taxes or that don't charge tariffs. So although Canada is the largest trading partner with the US, the Canadian government, even though they were saying that we are going to impose 25% tariffs on $30 billion worth of goods, remember the total trade between Canada and US is $669 billion. I think the countries here, there is room for negotiations and we'll have to wait and watch, but I think there will be a lot of hand holding and supporting each other. And these negotiation tactics will, I think, ultimately bring us to an equilibrium where both countries will be satisfied with how things are progressing. And there will be some, I think, sense coming up in the near future of how this is handled. Same thing with Mexico. So Mexico also has a lot of exemptions under the USMCA. So I think there are some negotiations that are going to happen, and we'll see some good signs. I'm personally pretty confident about that we're going to see some good signs. But ultimately, what happens, we're going to have to wait and watch. So this was just a table I wanted to share with you because as I start to look through the numbers, this is what I'm seeing, and I'm noticing that this is less about raising tariffs, more about economic leverage and opening US companies to foreign countries so that US products become more attractive, which ultimately helps US. Now, we have just talked about why these tariffs are being used, right? Leverage and not punishment. But is this the first time that we are seeing this play out? The answer is no. This is a story or this is a movie that has played out before. So back in 2018, if you notice here, back in 2018, something very similar had happened. And what had happened was that Trump was in power at that time and he had initiated a similar kind of a trade war with China. And that also rattled the market and it brought the market down to about 20.3%. And it brought it down. But what's interesting is that within 6 months, the market recovered fully and then it made all-time highs thereafter. Of course, in 2020, there was COVID, so that's a completely different story. But this kind of a trade war has happened. And since then, I have a chart here. So since the drop of about 20% in early 2019, late 2018, because of the trade war that had happened with China, the stock market then bounced. As of this morning, it was sitting at a growth of 134%. So what's a lesson here? That in the short term, markets misbehave, but in the long run, markets reach their fair market value. So the companies that are fundamentally not sound, they actually end up doing poorly. They may be very heavily reliant on debt or some kind of outside influences. So they end up often losing out or going out of business. But fundamentally strong companies end up adapting really, really well. Number one, many of them are not so dependent on loans. So they have enough cash flow so they can weather these kinds of storms. So essentially, the ones with pricing power and efficient operations and even strong customer demands, they essentially end up finding ways to protect their margins. And that's why, as investors, we have to zoom out instead of reacting to every headline and the signal. Invest in fundamentally strong companies as opposed to speculative companies. Now that I've walked you through the context, both historically and economically, let me bring you back to the real world. And I'm going to pull up TradingView and I'm going to show you exactly what's happening right now in the stock market, how far it's gone down. And let's do some technical analysis and see where we think the market may go. Okay. So here is the stock market as of very moment. So currently, this is the S&P 500. So its ticker symbol is SPX. Notice that it's currently sitting as 5,474. So as of this morning, the stock market definitely reacted and it fell. Right? And those of you who are in a Telegram channel, we were monitoring this. We were seeing what was going on. So also, you notice when you look at the kind of candle there is, as of now, it's showing that a lot of the negative sentiment that had gone down has been eaten up by bulls. So the stock market is already starting to go up. Whether it continues to go up is yet to be seen. Now, how much has the stock market gone down? So let's have a look. So this is the all-time high, like somewhere around here, right? This is somewhere around here. It's all-time high. So if I bring this down, all-time low that the market has gone to as of today was 11.85% since its all-time high, and all-time high was somewhere around the 19th of February this year. So the market has gone down as of today 11.5%. And remember, if it goes down more than 10%, that's a correction territory. Okay. Now, how far can it go down? Now, ultimately, nobody knows, but we can do some technical analysis. So let's do the technical analysis. So for technical analysis, what I'm going to do simply is for now, just kind of zoom out to weekly candles. And let's see where a resistance is. So I've actually already drawn a resistance. So the resistance point is right here, which is around $5,331. So right around that. Why? Because there are some resistances that became supports that were tested again a couple times. So, or three times they were tested as supports, and three times they were tested as resistances. So this seems like a strong support level. So if the market were to fall to this point, how bad is that? So let's see. So I'll go back up here to the same level, which is an all-time high, scroll down to this point, and that shows me a reduction of, or a dip of 13.19%. So remember, as of today, the market has already dipped about 11%. And if it were to dip to the next support level, that's 13%. So that's 2% more or less. That's it. So if the market were to go down, there's a chance it may rebound from there. Now, again, because we don't have a crystal ball, let's do some more analysis. Let's see where has it fallen in the past? And if the same were to be repeated, where would it go? So for that, I'm going to add to it an indicator of my simple and exponential moving averages. And let's zoom out and see what's happening. And I'll also maybe even convert this into a monthly chart. And notice, okay, let me also overlay this with US recessions. So the pink areas represent the timeframes when the US economy had gone into recessions. And typically when US goes into recession, a lot of other countries also have very similar kind of problems. So when did it go into recession? So once it was in 2008, 2009, 2010 timeframe, right, during the great financial crisis. And then it was just around 2020, a short recession during the COVID timeframe. And how much did the stock market go to? Just have a look at these moving averages and notice where it typically falls. So when it hits what do you call a recession, it pierces through the green line and further goes down. Sometimes it could even touch the orange line. But in most cases, if the recession doesn't occur, it seems to just touch this blue line, which is the light blue line. In my case, this represents, I think, a 40 exponential moving average, but on a monthly chart. So you notice it touches this part. When, again, it had touched this part. Here it touched that part, pierced through, but typically, let's say it touched this part many times, which is the turquoise line. And this time it has not yet touched that part. So let's say if the market were to fall that down because of these tariffs, what would that point be? So I'm going to go down again. I'm going to go back to that ruler, bring to my turquoise line, and you'll notice that is just 20.26%. What does that mean? 20.26% means just the bear market, because bear market is 20%. So if it were to hit that point, which is a turquoise line, the market would show that it has hit bear market, not necessarily recession, but it has hit bear market. And then let's see where it goes. In the last little while, whenever recessions have occurred, or the last recession that occurred, the market picked up fairly rapidly. And even during the last trade war, when the market dipped about 20%, the market picked up fairly rapidly. So whether that's going to happen or not, I don't know, but I wanted to give some perspective around that. If the market were to fall, where might it fall to? I think the more likely is that it could fall to the next support level around 13%. But if it were to go down, and if it were to convert into a bear market, then that's the level it'll fall to. So let me walk you through what's happening with two very key indicators. One is the US Treasury yield, and other is the PCE, which is the personal consumption expenditure. So these are some very important indicators that tell us a lot about what's happening in the market. Okay. So first, here's a 10-year Treasury yield, and this is something that what it has shown as of today. So you notice today, this morning, the 10-year Treasury yield fell. So if it falls, what does that mean? That means that people are buying bonds. So when people buy bonds, because the bond price is inversely proportional to the yield went down. So that means the bond prices have slightly gone up. So why would that happen? The reason that would happen is the retail investors are thinking that, okay, I want to put my money in bonds because bonds are safe, they're steady. So they're taking their money out of the volatility of the US stock market and putting it into bonds. But here's something else I want to bring to your attention. Notice the PCE, which is the personal consumption expenditure. What this means is the price of goods and how are they going up. So you notice if the price of goods continue to increase, that means this is an indication of inflation. So it means inflation is ticking up. So what we're seeing right now is something unusual. And what is that unusualness? When the bond yields are falling, this combination is a red flag. And why it's a red flag is because investors may be preparing for a slower economy with a lingering inflation. And this is a classic setup for what's called in the term of economics stagflation. Okay? So stagflation essentially means that the yield is going down, but the inflation is increasing, which means things are continuing to remain expensive, but people may be losing jobs and there may be a slowdown in the economy. This is specifically difficult for the feds to manage. Okay, but because what do feds do? Feds will typically come if the inflation is increasing, they would just say, okay, let me increase the interest rates. And if the inflation was falling or the yields are falling, they'll say, okay, we need to jumpstart the economy, so let me reduce the interest rates. But at this time, because inflation is increasing and the yield is going down, this is a concern that leads to stagflation. So this is where the feds now have to wait and watch. They have to wait and watch to see what the indicators turn out in the next little while because they can't just increase interest. They also cannot lower the interest rates. So what they might do, they might hold it a little while longer to see how the economy behaves and how this current news of increased tariffs actually get absorbed in the economy and how the economy actually behaves. Because who knows, maybe in the next little while, Trump may turn around and say, okay, I like this country. I think we've come to a deal with them. Okay, I'm going to reduce their tariffs, right? You never know. So that's how we have to wait and watch. But this leads us to another very important question, which is that if the yields are falling and the inflation is still high, what does it mean for the overall economic growth? And to answer that, we have to turn to one of our other very important real-time economic indicators that we have, and that's called GDP. Atlanta Fed that I mentioned in my recent podcasts, it's one of the Federal Reserves that monitors the movement of the GDP in real time. So how's that behaving? Let's have a look. So here's a chart from Atlanta Fed and their GDP Now model, and it tracks real-time economic data to estimate the GDP growth. Just a few weeks ago, the GDP was running somewhere around 3%, which means the GDP growth was at 3%. But after the new inflation data, inventory reports, and the consumer spending updates, it's now estimating the GDP to be around minus 2.1%. So notice how it fell. So it's sitting quite low now. And it continues to dip. So if you notice that if it continues to dip, why is that happening? Now, first of all, I do want to bring to your attention that this whole drop happened in late February. Why did this happen? The reason this happened is because President Trump had already indicated that I'm going to start increasing tariffs. So when he said I'm going to start increasing tariffs, the US importers increased their imports to such a large level that it started to show impacts on the GDP. So they increased the imports to bring in products early so that they can avoid tariffs on at least whatever they could purchase ahead of time. But now that the tariffs are about to increase, those imports are going to start going down. So we're going to start seeing that this GDP may not continue to go down. Again, we'll have to wait and watch, but I think it may not continue to go down as much. And this may start to settle out and then ultimately reverse. But the important point here is that changes like whatever's going on with tariff war, etc., how quickly they can start to have an impact on the GDP. And remember, two continuous declines in GDP, basically they lead to, by textbook, a recession. So right now, the whole quarter's GDP has not been yet tracked, but we're going to have to wait and watch how that turns out. So here's another chart that I have that shows now the probability of recessions. And what is this chart? This chart is basically a difference between treasury yields. So a long-term treasury yield and short-term treasury yield. So I'll just give you the math so you guys understand what this basically means. So you have the 10-year treasury yield and you have I think this is the 1-year treasury yield. So the 10-year treasury yield is supposed to be higher on normal basis and 1-year treasury yield is supposed to be lower. lower than 10 year. Okay. Now, why is that the case? Because they're essentially, if you leave the money invested in a bond for a longer duration of time, the bond is going to give you more money. So, same thing here. But sometimes what happens is the 1 year treasury, which is a short term treasury yield, actually becomes bigger. So, 1 year yield becomes greater than that of the 10-year yield. When that happens, this is called a yield inversion. You must have heard this term, yield inversion. What they basically means is that, let's say this is the long-term treasury yield, and then we have a short-term treasury yield. Let me put it in a different color. And this is typically the short-term treasury yield. When the inversion occurs, this one actually goes above the long-term treasury yield. And when that happens, that's called an inversion. Typically, why does the inversion occur? The reason inversion occurs is because investors start to get a higher return in their short-term bonds. And why do they get higher return in short-term bonds? Because there is a conviction at that time that the economy is not going to do as well in the long run. That's why the short-term bonds yield goes up. When the short-term bond yield goes up, that's a yield inversion. But what that actually represents is that the economy is not doing well. And historically, most of the time when this has happened, soon after that, we've seen recession. Now, has that happened most recently? Not necessarily, but let's have a look at historically. So all these points that are represented by the blue area represents the times that when recessions had occurred. So notice in 70, just before 1971, the yield had an inversion. So recession occurred. Then again in 1973, 74, yield had an inversion, and so the yield had an inversion again. There was a recession. Same thing happened here. Same thing happened. Now, interestingly, this happened very recently as well. Just a couple of years ago, as the US was fighting this increased inflation pressures, at that time the yield curve had also gotten inverted. So certainly a recession did not occur at that time. And right now, where does it sit? Right now, this figure sits at 27%, which represents that as of, and this was updated as of 6th of March. As of 6th of March, the probability of a recession occurring was 27%. And I've also read some articles from Goldman Sachs. They're saying right now the probability is sitting at 35%. So we'll have to wait and watch. But what does this show? This shows that we're not out of the woods yet, but we're not necessarily in a point where we can say, yes, there's going to be a recession. But I wanted to bring this to your attention that this is what the market is currently looking like. So what do we have to do? We got to stick to a process as long-term investors, right? We observe the signals, we understand what they mean for the long-term earning power of a company, and then we stay focused on valuation and resilience of companies. Okay? Now, folks, here's a chart I have that I've spoken about many times, but I think this is a good time to bring to your attention. So one of the biggest lessons in investing is the importance of sticking to your investments in the long haul. This chart is produced by JP Morgan, and it shows what would have happened to somebody who had invested $10,000 in the S&P 500 from the year 2003 to 2022. So this is almost a 20-year period. Notice, if somebody remained invested, that $10,000 would have converted to $64,844. And that takes into account all kinds of ups and downs the market would have gone through. But here's the thing. If somebody missed just 10 best days, then that amount of $10,000, instead of growing to $64,000, would have only grown to $29,000. Now, if somebody were to miss 40 best days out of 20 years, right? And if I take my calculator, I say 40 divided by 365 times 20, that represents what? 0.5% of the time, right? It's that low. Now, I don't know, and that's percent. And I don't know about you, but that's basically like saying I am going to be accurate well over 99% of the time in timing my market. So if somebody were to miss just 40 best days, their $10,000 would have actually now lost money. Again, they had to be accurate over 99% of the time. So what's a lesson here? Stay invested. Keep looking for opportunities. Don't put all your money in one shot, like the principles that I keep going through. the moment in time that we're going through right now is a great opportunity for us to rejuvenate that information, that knowledge. That market goes through volatility, but it's important for us to stay focused. That's why I want to bring to your attention that if you guys haven't yet signed up to the Telegram, sign up there, because there are like-minded people. People ask questions, other people answer those questions. I'm always there to also help and provide whatever guidance and input I can provide. Of course, we don't give any financial advice, but having a community and having that interaction is very important. So I want to wrap this up with this very simple reminder: markets will move, but you don't have to. Headlines will always find a way to shake things up, but real investing, the kind that builds long-term wealth, comes from staying committed to sound principles. And what are those sound principles? Evaluating businesses, focusing on intrinsic value, and understanding which companies are resilient. So, identifying their moat. Now, as we saw today, even when inflation is sticky, GDP slows down, or recession signals flash, the answer is not necessarily to react. The answer is to re-anchor. So re-anchor to your strategy, re-anchor to your process, and re-anchor to your plan. And most importantly, do not do it alone. Join our Telegram group. As I mentioned, we have amazing daily conversations about how to read market signals, how to stay calm during volatility, and just put some sense around what's really going on. And let that be your edge, folks. I'm not talking about trading. Trading, I think, is more like a gamble. You really have to know what you're doing. Long-term, traders lose money. But long-term investors make money. Look at how much Warren Buffett has made, over 5 million%, which is amazing. So again, please remember, the most powerful thing an investor can do is to stay in the game with conviction, not reaction. And ultimately, time in the market is more important than timing the market. Okay. Now I'll open it up to any questions you guys may have. Go ahead, guys.
Amit, in the previous slide, 2 slides before, where you had not this one. Yeah. So what do the highs indicate? The highs.
Okay. So whenever there is a difference between long-term and the short-term treasury bonds, as that gap increases, that can lead to a recession in the future, because the investors think that the economy is not looking good from a long-term perspective, but short-term it's better. So they go for safer investments and safe haven bonds with shorter turnarounds. So again, to answer your question, it shows what is a probability of us getting into a recession.
Oh, so the y-axis is actually the probability of getting into recession.
Correct.
Okay. Thank you.
Right. And that probability is the difference between the yield curve, so short term and the long term. So as this difference increases, so this is the difference. This difference is the values of the y curve.
Okay. Thank you.